Okay, gold has been on an absolutely wild ride. We're talking record highs 1 minute and then a shocking crash the next. And silver? It just had its worst day in decades. So the big question on everyone's mind for February 2026 is this just a healthy correction, or is this the start of total chaos? We're going to break it all down right now. Let's dive in.
So get this. On January 29th, just a few days ago, gold hit this absolutely staggering record high, nearly $6,000 an ounce. The market was on fire, euphoric even, after a 64% gain in 2025 alone. It honestly felt like the rally would just never end.
And then, bam! The floor just completely fell out. The very next day, gold suffered its steepest one-day decline since 1983. It plunged traders into a state of shock. I mean, years of gains were literally threatened in just a matter of hours. And it wasn't just gold. Oh no, the chaos spread like wildfire as silver collapsed an unbelievable 36% in a single day. And now, Wall Street is completely torn. You have the bulls calling for a massive rally to over $6,000, while the bears are warning of a collapse all the way back down to 4,200. So to make sense of all this, we're going to quickly cover 5 key things. We'll look at the crash itself, the bull case, the bear case, what Wall Street is predicting, and finally, the most important data you need to watch in February. First up, the crash. Let's try to understand the perfect storm that led to this historic, well, frankly, insane volatility. You know, what's really crazy about this is just the sheer speed of the whole thing. January 29th, we're at a record high. The very next day, a historic crash. By February 2nd, the price finds a bottom, and just 2 days after that, it's already roaring back over 5,000 bucks. This isn't a normal market, folks. This is a battleground. So what on earth caused this? Well, it was a perfect storm. First, the market was severely overbought, which is just a fancy way of saying the price went up way too far, way too fast. Second, the exchange hiked what they call margin requirements 5 times. This basically made it a lot more expensive for traders to hold their positions with borrowed money, and that forced a ton of selling. And the final trigger was the fear of a new hawkish Fed chair, someone likely to raise interest rates, which could be bad for gold, and that just sparked a massive chain reaction. All right, so now for the other side of the story, the bull case. Here's why some people believe this rally is actually just getting started. And this quote from JP Morgan? Man, it just perfectly captures the core of the argument. They're not talking about short-term fear here. They're describing a long-term structural shift where the world's biggest institutions are moving away from paper assets, like stocks and bonds, and into real assets like gold. The bull case really rests on 5 huge pillars. First, central banks are buying gold at a historic pace. Second, geopolitical tensions, especially with Iran, create uncertainty, and that drives people to gold as a safe haven. Third, we saw massive physical buying coming from Asia right after the price dropped. Fourth, the market is betting the Fed will have to cut rates soon, which is usually great for gold. And finally, and this is a big one, a potential disconnect between the paper price of gold and the demand for the actual physical metal, which you can see in the spiking premiums. And this chart really visualizes that institutional demand. I mean, look at this. After years of buying around 1,000 tons, central banks added another massive 860 tons in 2025. And JP Morgan thinks they'll snap up another 800 tons this year. This isn't just speculation. This is foundational global demand for physical gold. But hey, for every bull, there's a bear, right? So let's pivot to the other side of the trade. Section 3, the bear case, and the argument that a much deeper, more violent reset might still be coming. The bears, well, they look at the exact same events that caused the crash, and they don't see a one-off event. They see it as the beginning of a larger trend. They argue the market just went up too far, too fast, and that forced selling we saw was just the first wave. Now, what's really interesting here is the argument around silver. The bears see silver's 36% one-day collapse as a huge warning sign, kind of like the canary in the coal mine for gold. They also point to massive profit-taking, that unsustainable parabolic rally, and the fact that previous historic gold bull markets, like back in 1980 and 2011, both ended with some very deep, very painful corrections. So, what you have are 2 incredibly compelling but completely opposite arguments. How in the world is Wall Street supposed to process this? Well, let's get to Section 4. Wall Street's absolutely wild forecasts.
And this slide just says it all. The gap between the high and low forecasts is over $2,000 an ounce. That's insane. On one end, you've got the bears targeting a correction down to 4,200. On the other, you've got JP Morgan with a stunning $6,300 target for the end of the year.
And as you dig deeper, you can really see the divide. You've got heavyweights like JP Morgan, Wells Fargo, and UBS, all clustered up there above $6,000. But then you see Macquarie with an average price forecast of just over 4,300. This isn't a minor disagreement. It's a fundamental conflict over where gold is heading next.
So, all of this brings us to the most important question. How do you navigate this? Our final section is a checklist of the key data points you absolutely have to watch in the critical days ahead.
Okay, here is your checklist for February. First, watch the $4,800 level like a hawk. It's critical support. Next, you have three huge reports: the jobs report on the 6th, the CPI inflation report on the 11th, and the FOMC minutes on the 18th. Then, keep a really close eye on silver. If it stays stable, that's a good sign for gold, but another crash would be a major warning. And finally, watch the dollar index, or DXY. A weaker dollar is almost always strong for gold.
So the crucial point is this. The market is completely torn between a fundamental bull case and a technical bear case. The economic data that's coming out this February will likely tip the scales and decide which side wins the next major battle.
Which leaves us with the ultimate question for February and beyond. After all this historic volatility, is the great gold bull market over? Or is it just getting started? Let us know what you think in the comments.